What do companies and investors do in order to determine whether or not the company is performing well? One way to evaluate a company's performance is through ratio analysis. Ratio analysis is a tool used by managers, credit analysts, and stock analysts to examine financial statements. It helps them identify weaknesses in the company that need to be strengthened in order to maximize stock price. Ratio analysis is broken down into 5 categories: liquidity ratios, asset management ratios, debt management ratios, profitability ratios, and market value ratios. Let's take a look at each category and discuss the ratios that fall under them. First are liquidity ratios. These give us an idea of the firm's ability to pay off debts that are maturing within a year. They answer the question of whether or not the firm can meet the required payments as they fall due. Liquidity ratios include the current ratio, acid test or quick ratio, average collection period ratio, accounts receivables turnover ratio, and inventory turnover ratio. Second are the asset management ratios, which give us an idea of how efficiently the firm is using its assets. They answer the question of whether or not the firm manages its assets efficiently to generate enough sales. Asset management ratios include basic earning power ratio, also known as the operating return on assets or ROA, operating profit margin ratio, total asset turnover ratio, fixed asset turnover ratio, and day sales outstanding ratio, as well as the accounts receivable and inventory turnover ratios. Third are the debt management ratios, which give us an idea of how the firm has financed its assets, as well as the firm's ability to repay its long-term debt. They answer the question of whether the firm finances its assets with the right mix of debt and equity. Debt management ratios include the debt-to-equity ratio, the debt-to-assets ratio, and the times interest earned ratio. Next are the profitability ratios. Profitability ratios give us an idea of how profitable the firm is in operating and utilizing its assets. They answer the question of whether or not the managers are providing good returns on shareholders' capital. Profitability ratios include the return on equity ratio, or ROE, and the return on total assets ratio, or ROA. Lastly are the market value ratios, which give us an idea of what investors think about the firm and its future prospects. They answer the question of whether the firm's managers are creating shareholders' value. Market value ratios include earnings per share ratio, dividends per share ratio, book value ratio, price earnings ratio, and finally, price book ratio. Although ratios prove a useful tool, they also have their limitations. For one, they are more useful for narrowly focused firms. With that, competitors are easily identified, and knowledge of the industry leaders' ratios will help massively. Remember that you must be careful in analyzing, since market values and inflation change all the time. In relation, it is also important to take note of the seasonality of businesses. You must be aware of window dressing techniques, which are techniques employed by companies to make their financial statements look better than they really are. This will determine the accuracy of your analysis. Although there are standard accounting practices that apply, companies may still adhere to various ones, which result in different outcomes and in distorted comparisons. Lastly, determining whether ratios are good or bad is always subjective to the one doing the analysis. Another tool that can be used to analyze a company's performance is the DuPont equation. The DuPont equation shows that the rate of return on equity can be found as the product of profit margin, total assets turnover, and the equity multiplier, as illustrated below. This, in turn, shows the relationship among asset management, debt management, and profitability ratios. Trend analysis is used to assess the firm's financial ratios over time. It is used to estimate the likelihood of improvement or deterioration in its financial condition. Benchmarking will also come in handy as a comparative ratio analysis. It is the process of comparing a particular company with a set of benchmark companies. It makes it easy to see where the firm stands relative to their competitors. All of those ratios and analysis tools definitely seem like an information overload, but they're all very much useful. Here are some ways you can apply them. Ratio analysis and benchmarking can be used to see the firm's place in the industry. They can also be used to compare their performance with their competitors. The different ratio analysis categories have practical uses for various operational undertakings, such as borrowing money and firm expansion. Evaluation via the ratios gives a picture of the firm's current position, and forecasts regarding next moves can be made accordingly. Ratios are used to determine the firm's return on equity, or ROE, which managers primarily set their focus on. The DuPont equation is good for comparison of the firm's ROE versus the industry's. Since it's personal to the firm, it makes clear what exactly the firm needs to do in order to improve their performance. Now, you may ask, how are these tools used in the real world, and what are the implications of using or not using them? Travelodge is a chain of hotels and motels in the UK, US, Australia, and other countries. The company was bought out in 2006, which resulted in a highly leveraged balance sheet. Business revenues of £335 million, an EBITDA of £47.8 million, and bank borrowings of £500 million resulted in a 10-to-1 ratio of bank debt to EBITDA. Now, Golden Tree Asset Management and Avenue Capital are prepared to underwrite a £60 million loan and probably take control via a debt for equity swap. After the credit crunch, Luminar, Britain's biggest nightclub operator, which operates Oceania and Liquid bars, was deep in debt of £90 million, and creditors were seeking repayment. Ratio analysis, specifically the EBITDA ratio, was used in order to assess how much Luminar could borrow. Luminar was said to have been already borrowing at its limit, which resulted in the need to liquidate assets in order to raise capital. The top 20 companies in the world, according to Fortune, are Gazprom, ExxonMobil, Industrial and Commercial Bank of China, BP, China Construction Bank, Petrobras, Barclays, Microsoft, Walmart Stores, Vodafone, Procter & Gamble, International Business Machines, Goldman Sachs Group, Merck, AT&T, Royal Dutch Shell, Banco Santander, Wells Fargo, Johnson & Johnson, and Bank of China. The 20 were analyzed using DuPont equations, in which companies were assessed according to their ROA, ROE, and ROS. This proves that investors should be looking into more than just a firm's profitability. Hope you enjoyed this quick lesson on financial ratio analysis. Keep these in mind because you'll never know when they might come in handy. Till next time!